Welcome back to another episode of ENO8 Answers. We've got a great guest today that I'm really excited to talk to. I think he's got a lot of insights that will be really relevant to a lot of our audience. And so Greg Head, I'd like to welcome you. Thanks for joining today. I think we're really excited to hear about a lot of your thoughts on sort of the startup scene, software startup, SaaS, and we've got an interesting perspective that I think is going to probably lend us a lot of nuggets out of the conversation today. So thanks for joining us.
Yeah, hope so. Good to see you, Jeff. Happy to be here.
For those that may not be familiar with you, tell us a little bit about, kind of where you kind of fit into the space and what you do, and just kind of give us a little bit of general, context.
Yeah, I'll give everybody a little context for my views and opinions. So when they hear me speak, they'll know where it comes from. You and I have met here in Dallas, helping out in the software scene, but I haven't been in Dallas for more than a few years recently. I was here 30 plus years ago with a little software company that grew fast and sold to a Silicon Valley company, Symantec, way back then. So I've been doing the software game for 30 plus years, growing companies, 3 companies, several I helped start, 2 to 100 million, 1 IPO. And for the last 8 or 9 years, I've been hyperactively helping serious SaaS founders all over the world, including here in Dallas. And my current focus is what I call practical founders, who are serious software founders, SaaS founders, who are building valuable software companies without big funding. So there's the go big and go home and raise big funding and VC funding. And I've played that game and I've won that game as well. But these days, the software game has changed. Doesn't take as much to build software. It doesn't take as much to go to market. And you can get into really exciting valuations for your company and options for founders without having to build a $100 million company like we used to. So I run CEO peer groups. I'm a paid advisor, strategic advisor to a bunch of founders. I'm an active LinkedIn contributor, one of the most popular on LinkedIn. People may have seen me there. And I have the Practical Founders podcast, so people can find out about all that at practicalfounders.com.
Yeah, this concept of practical founders, I've always thought that was a really clever way of sort of describing a type of founder, a type of startup. What do you think, what distinguishes a practical founder from, I guess, a non-practical founder? I don't know what those buckets, maybe it's VC funded path versus like self-funded, but what in your mind makes up what you call a practical founder?
Well, I've played the bootstrap software game and the VC funded, go big or go home game as well. And there's a place for each, and I didn't invent either one of those. But like I said, about 5 years ago, after I'd come to Dallas, it was more clear to me that the software game was changing. VC funds had gotten bigger, their checks had gotten bigger, which means the risks have gotten bigger. And Jeff, when I say practical founders, I do mean all of the SaaS founders in North America and around the world who are creating software businesses, growing them, and they're still really valuable, but they're doing it without VC funding. So it's the hidden majority that we don't hear about. The funding industrial complex highlights funding announcements and pushes and promotes those for a lot of clapping. We see, of course, the big public companies and, the unicorn success stories, which are, there's a place for that. It's just of the VC funded minority, left fewer than 20% of all software companies here in the US get VC funded. Of that minority, 1% of that are the ones we hear about that are $1 billion success stories, like a few dozen. So for most founders of the modern era, vertical software, they're trying to create a software business, it doesn't make sense to raise VC funding. And I'm really saying it's impractical. And no VC is arguing with me on that. I still know hundreds of VCs, and they know they're not for everybody. It's a very specific pro game, if you will, with all kinds of specific risks and rewards if it's played right. But founders usually don't win that game. And nobody's talking about the ways to do it that without VC funding. And self-funding, bootstrapped with your time or money is one way to do it. There's other ways to do it too.
Yeah, you're right. That doesn't get hardly any of the attention. It's always that sort of more unicorn sort of scenario that gets a focus, is there sort of at a high level, is there sort of a size that you think, like, or when you're looking at these opportunities early on, is there sort of a general size that it kind of breaks one way or the other?
Yeah, I think it's definitely about size. So if you say to a venture capitalist, even a nice one who invests small checks and is very friendly with you, and say, gee, I want to grow this business to $10 million a year in revenue, annual recurring revenues, and sell it for 5 to 10 times that, $50 million, $60 million, right? They look at you like, well, I can't help you at all. Good luck.
Yeah.
And that would be a founder scale exciting exit, but that would be a loss for a venture capital investor unless you raise just a little bit of money at a very practical valuation and they got out just in time. Like, there's really no place for institutional capital when a founder grows a business and sells it for $50 million, right? And my podcast, that's the average of what founder equity value has been created, either through a sale or as they're building the company. So you have the optionality to keep on going. So I think anything, for the most part, if you say, gosh, I could imagine growing this company to 5 million, 10 million, 20 million in recurring revenues of the modern software as a service recurring revenue business, you ought to be very circumspect about raising institutional capital, a fund with a professional investor and all their lawyers, so forth. They can really help, but it's rocket fuel for rockets, and you don't need rocket fuel if you're growing to 20 million and somebody's going to buy you for $100 million, which happens all the time, and we just don't hear about it.
Right. And I guess, I think probably a big part of your point is that a $50 or $100 million exit for a tightly held or even single, owner business, that's a really nice exit.
It's huge. You can change an industry. You can change your corner of the world. It's quite a myth that you need to raise VC funding to be successful. And it's actually counterintuitive, but 70% of founders who raise institutional VC funding, and they're not stupid founders, and VCs aren't evil. It's just the game is played that way. 70% of them walk away with $0, right? It was worth a shot, or I didn't know the game I was playing, either one of those. But and sometimes it works out. Like, you have better odds of some in 1% of 1% of the chances reaching $1 billion, and there's plenty of bootstrap billion-dollar software companies too. But it's just a different game, and it was completely underserved. And literally the game changed in software, but VC funding, and you need to raise funding to do it, which I've done like 20 and 30 years ago. That's what you did. So we don't have to do that anymore. And it's better for most founders.
Yeah, the large majority.
Yeah.
So, you work with a lot of founders. I would assume a lot of those are probably first-time founders. What's the biggest myth that you can think of that first-time founders get wrong?
Well, the first one is around funding, and the crowd surrounds them. Oh, congratulations on your startup. When are you going to raise some funding, especially in big cities? Dallas doesn't have so much of that because there really aren't funds hanging around here, and it's not what cool kids do here. But Austin and almost every other big city, including London and the rest, that's the first myth. So we talked about that, and people can find out more at practicalfounders.com. The second one is they think, I see a problem in the world. I've talked to a few people. I'm going to go start building, and then I'm going to come back and after I've built a product, start selling it. And that's kind of the trap of the modern world. You help companies build software, and it's hard to build software, and it takes an investment and so forth. But it's figure-outable. If you do the work in your design process, if you do the work to build it the right way, if you've listened to customers about what they really want, and you've done some detailed work to figure out what that is, and not just simple stuff, you can build the product. But getting customers to buy it and then building a repeatable engine where you can sell product that delivers value, you can sell more, and you can repeat, that's the hard part. So once you get past building a product, if people buy it, then 90% of the next years of your life is all about marketing and selling, your go-to-market.
Yeah. And it sort of, the big leverage point there is picking a worthy problem to solve.
Yes.
Right.
There's all kinds of problems. So another first-time founder one is picking the first one you see.
Yes, there you go. Yeah, first idea that comes along.
Yeah.
So when you're talking to somebody, what are some of the types of questions that you ask that help you sort of size up? Are they onto something? Is this really like a worthy idea? Like, what kinds of things are you looking for? What do you ask?
Yeah, that's a great question. There's a lot of people in the world that'll congratulate you on your startup idea, not knowing what you've done or if it's working or whatever. And then there's plenty of people saying, come on, more startups because you should get funding. So there's a lot of encouragement. The drug dealers out there selling funding. And founders get kind of caught up in their own hype cycle, right, around them. So I asked them first about, okay, what's your product and who do you serve and how far along are you? Do you have a product yet? Is somebody using it? Has somebody paid for it? How many people have paid for it? And keep on going there. So it seems kind of obvious, but if once you have 100 customers that pay for your product and it's a sizable product, you've kind of figured something out. Jeff, I would say that of the founders that have an idea that don't have a product yet built, maybe 10% of them get there. And of the ones with a product built that think they have customers lined up ready to buy it, I'd say 10% of those get to, I got 10 customers that pay me for it and give me a thumbs up. And so I'm kind of judging how much learning they've had and how much proof there is. And it's not unlike what VCs do to you. If you say, I want to raise some funding, they say, how far are you? And they'll tell you to wait for more, they want to wait for more traction, more proof. So generally, revenue and customers are more valid as proof than, oh, it works and my customers love it and it's amazing and I'm sure it'll be big.
Right. Yeah.
Which I don't know.
The proof is whether people will pay for it, right? And I think one of the traps that I see a lot of times is people will circulate the idea among their circle and get a lot of feedback that this is an awesome idea, right? And that's sort of a trick because a lot of times people will tell you they like the idea, but the real proof is like paying customers. Someone, will you actually pay or will you commit to paying as we're building the product out early on? Which I think, you and I've talked about a lot of this over the years, but that early stage, people get so caught up on, the fundraising or the idea as a concept, or when they actually start building it, really building the perfect product and their vision gets really big. I think that hurts a lot of people is trying to tackle too much. Right. But if you think back about some of the founders that you've worked with over the years, I'm sorry, I'm going to put you on the spot a little bit, but so is there any example of someone who did a really interesting or clever, had a neat way of going at validating or getting that sort of early indicator that people will buy this? Like, is there anything that you've come across before where somebody just did a really great job of figuring that out pretty early in the process somehow?
Well, it's kind of a trick that we have to, it's a trap that founders fall into themselves. They're building it and they're not getting a business started. They're building a product, but there's no business there. And it's a trick for us to say, I believe in this customer and the problem, and I'm going to help. And then you have to stand back at the same time and say, but I don't know if this is really what they want. It's a little schizophrenic for founders, but it's actually kind of useful. So I think I just had somebody on my podcast this last week who said, well, you got to answer, can you build it? That's usually the answer is yes. Will somebody pay for it? Okay, that's usually debatable. And then in the long run, will people pay you enough for it, more than what it costs you to build it and run a business? And just to even know that you have thousands of ideas and you're over optimistic about things in the beginning. But there's a chance and that could work and it would still work. The founders have this trick where they tell themselves, I believe I'm going to be successful, but I have no idea if this customer will buy it. Now, that's different than not selling it strongly, right? And not, digging in or whatever, but they don't take their own word for it. They take a customer's word for it, and they follow the customers. So you should get funding. Well, I haven't even sold one yet. Like, stop. Well, you should get an office. I haven't even got enough customers that would pay for the office. So they put the revenue out in front of them mentally and say revenue first before I start hiring, which for years it wasn't revenue first. It took so much effort to build a product and capital and offices and all that silly stuff that you got, and servers, and a lot of expense to get started 10 years ago, 20 years ago, 30 years ago, especially. These days, it's counterintuitive, but saying, I'm going to prove it with revenue to myself first.
Yeah. Yeah. And it's a different, I think, it's a different game today because, like you said, the difficulty and the expense just to launch something was a lot different 10, 15 years ago than it is today. An example I use pretty frequently is take like AWS as an example. So many things that I remember we had to build custom, from the ground up 10 years ago is stuff that's, available and ready to use, right off the shelf.
Yes.
And I think, that's impacted things a couple different ways I've seen. One is there's not as much of a focus on what technology you choose, right? Some of that's like sort of evened out some where it's less about choosing the right technology. It's less about the upfront expense of building out servers and infrastructure and things like that on your own. And, more and more and more importance gets shifted to that really front end piece of, am I solving a good problem? Is it an expensive or painful problem for people? And am I making it easy for them to understand how my solution addresses that? Right. And, I think that a lot of that effort that got spread across different parts of the journey before has really started to become collapsed in that front end piece, because, man, if you don't get that first part right, am I pursuing the right thing? You can't build a perfect enough software product to overcome a problem nobody cares about.
Founders get stuck in that one. They think, gosh, everybody wants this. I talk to people, they're giving me thumbs up, and they go back out and realize, well, they're not willing to part with their hard-earned dollars as easily as I thought. Or if you're not in a boom time, like we're not now, budgets are stingier, decision processes are more rigorous. People aren't consuming a ton of software just willy-nilly. So it's harder to get people to part with their money than you think. So this problem you solve has to be big enough that they'll pay you, and high enough on their own list that it's one of the top 5 things they've got to do, or their business is going to suck this quarter. So those are 2 really high bars these days, and that's kind of the challenge.
They are, and there's a lot of competition for that attention, and just like, even, like you said, the money, it's almost like tool overload. I don't know about you, but there's so many different new tools and things. It is, right? And so I think, you probably heard us talk a lot about like the concept of minimum lovable product. And I think one of the things that I love about that approach versus like an MVP approach is that it considers more than just what's the minimum feature set. And I think a big part of one of the things you have to consider is how easy can I make it for people to start using this and incorporate this, right? Because if that friction is really high, you can have a really great product again. But if it's too painful to implement it or to start using it, again, that's one of those friction points where it'll prevent you from getting users really early on, even if you got something really great, Yeah.
I like that term, minimum lovable product. And I think when I'm saying about get to revenue first before you invest a lot, that requires some experimentation and some testing and some real world selling. I've got this. Do you really want to buy it? Right. As opposed to something pantomimed before you have a product. So I believe in the version of minimum viable product and running experiments. But what's lost on it is that it has to be amazing, not just a minimum viable or a minimum sellable. The people who created that term said it has to be amazing enough for somebody to solve a serious enough problem that they'll change their behavior, do something differently, which is really hard. The old days we used to talk about it has to be 10 times better than what they're doing now, the manual way or the other software tool way. So I totally agree that founders are underestimating how amazing their software has to be to that customer to just sell it, keep them using it, and have them change from what they were doing before.
When we talk about those practical founders, what's a pretty typical journey you see them take as it relates to funding their startup?
You've seen my gregslist.com list of all the Dallas software companies. Well, 20% of them are institutionally funded, private equity or VC. 50% don't have any outside funding, including some startups and that. The first one is, and it's the most common, I would say, I've got a services business, a previous business, and I've got team, and I've got a little profit, and I'm doing this long enough that I found an opportunity deep in my client base, and I started building software for them. I put one person on it, two person. I started selling this software. And lo and behold, I had proved that customers would pay me for a software product, and it sticks. And it's very common.
So product born out of an existing business, that's kind of what you're saying?
They're trading their own profits, which they could have put in the bank, or their own team, which they could have taken as profits, and investing there. It's very common for software businesses. A second one is investing your own time. So a coder codes at night. Somebody or two, one starts selling and one starts coding, so forth. So that's an investment. There's opportunity cost of that time. The next one is a combination of that, and I use some of my savings to have somebody build a product for me. Right. So whether that's locally or offshore, or that guy, that story of that guy, which doesn't usually work out. And most products that solve real problems 10 times better than the existing solution don't take $500,000 to build, to get up and start serving people and prove that there's something there. So sometimes that's savings there. And if you minimize your investment and you hurry up and start selling, then customer funding revenue is, eventually what takes over pretty quickly. And so, most practical founders out there live pretty lean and invest their own time and, their money. Another one is a little bit of angel funding, friends and family who donate to the cause. That doesn't put you on the track of be a unicorn or we're going to shoot you, like most VC funding. There's a few other ways in there, but those are the big ones.
Yeah. I think that matches with what I see. I think, a lot of times I'll see founders, invest a little bit of their own money, like you said, to kind of get started. Friends and family is a pretty typical stop along that path a lot of times. And then, once everything changes when you have paying customers, right? Like you have lots of options at that point when you can show that you got traction. Right. Exactly. And so, your options are, so I think, would you agree with that? If possible, I encourage to find ways to self-fund or friends and family fund until you can get traction, because your options get a whole lot better after that.
Jeff, here's a better way to put it. I'm shocked that isn't rule number one in entrepreneurship classes and what people tell each other and ecosystem events and all of that. We're starting people off on the hardest funding drugs possible, saying, you need to go raise funding and go pitch and do all this kind of thing. There's a place for that, and sometimes you need to do that. I'm not against it. I'm just saying that it's completely overprescribed by funders and misunderstood by most founders. Be clear. You shouldn't raise outside funding until you know you can't go another foot without it. You should procrastinate funding the whole way. And hurry up and sell something to prove it and get revenues coming in. That's getting easier. AI is making that easier. It's changing that 10x quotient as well. What's really way better. But every year it's getting easier to create software. So it's about finding the place of value and figuring out how you can sell it effectively.
Yeah, I think me and you could go off on a pretty big soapbox on this topic because you mentioned it at the very beginning that so much attention is placed on who raised money, right? That's the one that gets the news articles, and the magazine covers, and all of the attention.
And the clapping, even though it's like they get the largest dose of opioid drugs ever prescribed. And I wonder if they'll be healthy in a few years and survive. And the odds are
you've probably seen this. Well, you've probably seen this. I've seen a lot. I'd be interested in your thought. Like I've seen so many companies that look very successful on the outside because of the press and how much money they raised, and then silently, fall off after that money runs out, and so much attention about like creating a startup or starting a new business, especially technology, is the first place you start is learn how to pitch and, create a pitch deck and enter pitch competitions and get coaching for pitching and that kind of thing. And like you said, that was
surprisingly, it's still, still out there, even though the world has changed for founders. Some things haven't changed in the software business, but funding and getting into business, like if you literally go to Austin, a pitch event, Capital Factory or something like that, or go to Silicon Valley, I'll be in San Francisco this week, and you go to visit VCs and talk to VCs, and you say, I've got this idea, I've got this product, I've got this startup, they're going to say, well, call me back when you get to $1 million in revenue and you've proved something and you know what you want to do, and that our funding is the exact best thing for the kind of business you're kind of creating. So founders can waste a lot of time playing the funding game that people who did it 10 or 20 years ago tell them that's what you do. It's not anymore.
Yeah. Do you see any patterns, Greg, about, the companies that do need a lot of funding to grow?
Oh, sure. Yeah.
Is there does that typically go more towards building out sales team and sort of go-to-market team, or is that typically product focused, or is it vary a lot? What do you see?
There's a couple of phases there. So if you're building an AI platform, and it has to be one of the big billion-dollar, multi-billion-dollar platforms, those take a lot of funding. If you're building AWS, that took billions of dollars of funding from Amazon. If you're building out some mega platform like that. But most software that founders that you and I are talking to are not talking about this. Yeah. And they'll try to convince you they are, but they're not. The second one is if you get to $1 million in revenue, and then all of a sudden you jump to 3, and then it goes to 10 million in revenues, VCs are like, okay, put rocket fuel on that rocket. Yeah. And that includes more marketing, more sales, more engineers, and that can be a good bet. That is the old, literally, this was talked about this week at Silicon Valley. This is the old triple, double game for VC. If you are not going to go triple your revenues this year, triple again next year as a startup, then double it, then double it, then double it, and go from $1 million to $50 million in a period of 5 years, then you shouldn't raise VC funding. Yeah. So how about that's another way to say it. Like it would just be bad drugs for you. So, but they're still investing in those hot companies that grow and throwing rocket fuel at it. That's a place. I've done that before and it worked. Right. But it's really hard to do, especially in the modern era. So this was a while ago.
Yeah, and if you think about back to practical founders, right? If they're focused on their product, they're focused on understanding their market and their customers up front, and then they're figuring out what is the MLP that they can launch something with and actually get people committed to using. If you focus on that and you're still not able to raise $50, $100, maybe $150,000 by way of your network or friends and families, that could be a pretty telling sign because that tells you something about how good your idea is. Being able to raise that relatively small amount of money to get through that phase of it, that could be an early warning sign that you're not really focused on the right thing.
Right. Whether you're VC funded or bootstrapped or somewhere in between in the practical spectrum, and that's what I'm talking about here, in between the simple bumper stickers of big VC funding and create a unicorn and bootstrap and stay in the corners and do it yourself. There's all kinds of ways to do it in the practical founder spectrum. But the game is still to create something that's valuable and get into revenues pretty quickly. And the modern era currently, if you get a company to 1 or 2 million ARR, there are people knocking on your door daily trying to buy your company for a song. But like a $5 million company is worth $25 million if it's reasonably healthy and there's a growth rate and isn't burning too much or isn't wildly profitable. I mean, that's pretty in the running. That didn't used to happen either. So
yeah, and it's easier than ever to get that as long as you're pursuing the right thing, And
yeah, totally.
If you think more about like let's talk more generally about mindset, right? Because I think what's cool about your perspective is that you talk to a lot of different founders, and I'm sure that there's a wide variety of backgrounds and experience and that kind of thing. Is there anything? Are there certain attributes or elements that you see as sort of a common thread about the founders that have been really successful? Like, what does that look like?
Yes, and I've interviewed them on my podcast. I have 40 founders in my peer groups, and that I advise, and I'm inside their businesses every month. Good. So compared to everybody else, these people are unusually hardcore and practical.
Okay.
They're not flighting around saying, oh, my idea is great, and I just heard this thing, I should do this. And they're very disciplined people, and they're not all first-time founders. So they're, most of them are a little older. They have experience. They see where a problem is, and they're investing. And it never occurred to them to go raise silly funding and do these things. So they're all kind of hardcore people. They all have some kind of superpower that's unusual about them. Whether they're an immigrant or a former pro sports athlete or they've created 6 companies, you say, what's unusual about you? They'll know right away. And they, they're kind of skeptical about what everybody says you should do. So they're a little counterintuitive, contradictory, counterculture, if you will.
Yeah. Confident in that as well, probably. Right. Yeah.
Here's another one. This came up when I interviewed Charlie Alsmiller from Dallas here on my podcast earlier this year. Most practical founders are really hard workers, very savvy, savers. They don't spend a lot. They don't have big house. They're not consuming a lot. You should be able to invest 50 or 100,000 of your own money at any phase of life to start a software company. You're not going to make money for a few years, whether you're VC funded or bootstrapped. You need to survive on almost nothing for 3 to 5 years before you really make a paycheck. I don't know who isn't telling everybody this. So those are a few traits there. And they just have attached themselves to a particular crowd, like I have, and a particular problem that crowd has. And they're not letting go.
Yeah. Yeah, it's funny. As you're talking there, I think through a lot of the founders that I've worked with, the ones that seem to be doing the best, and they a lot of times fly under the radar. They're not the ones that you hear about.
The definition, right?
Yeah. They're focused on the right things, and their heads down the product, their heads on the customer.
So they're playing. They know what game they're playing. Would be another way to say what they do. There's other games to play. Go be a corporate executive, right? And go, whatever, spend time with your family. This is kind of an extreme sport, and they have chosen a swim lane, the practical founder approach, which is actually more than the funded approach. And Greg's List Dallas, there's way more out there. So, and a lot more, you would say, have experience either in an industry or they've built a couple businesses. They're not wildly successful, but some of the founders that I've interviewed here in Dallas have put millions of their own money after selling previous businesses into building the next thing. And they wouldn't think of raising VC funding until they knew that was what you would do, it would make sense for them. So,
you kind of mentioned it there. One of the things that I see pop up a lot is that they come from an industry or a space where they had a really unique view of what's going on there. And maybe they worked in a particular industry and that's where they spent a lot of their career and they experienced that problem, kind of firsthand and had access to people who would be potential customers. That's an ingredient when I see that show up a lot of times that really changes the odds.
Yeah. And that gives them a head start. They they had the problem. They know people with the problem. Mike Kovarik on my podcast, I knew in Phoenix for many years. He worked in the food distribution industry. And the second tier, where all the restaurants and all the places get their food if you're not a grocery store. These are huge billion-dollar companies, but they have really outdated technology. Well, he was a data guy in one of these companies, so he was right there with the problem. And he said, we have this problem. We need to make software. No, we can't do it. How about I make the software? And he sold it to them. And then he went around to everybody else and said, I bet you have this problem. He said, yeah, how about I come out and show you how we can solve that problem? And he created a creative solution for them all to say yes. And it got it to $5 million in ARR and recurring revenues in 5 years, and he sold the business. So that's pretty typical. Vertical expert with a technology bent.
Mm-hmm. Yeah, good. If we focus a little bit, a lot of our audience, we're our angle on things is a little focused on the product development piece, right?
Sure.
And, part of the reason why we as a business, we focus a lot on the front end that you and I've talked about of like really making sure we understand the user and what it is we're solving and kind of the value that the solution brings. Because if you don't do that, then you really are going to waste a lot of effort on the product development, right? Yeah, exactly. And it happens a lot. If you think about like if we focus on building the product, is there some advice or some insights you've seen over the years of things to keep in mind as you're building your product, common pitfalls, anything like that comes to mind that you think would be good for founders setting out on that journey to know about?
Well, the biggest thing that founders look back and say, what would you have done differently? And they would have said, I wouldn't have built so much product until I started selling and knew what customers wanted, right?
Yeah.
So that, they don't get too far ahead and they don't spend years building something and then realize 2 out of the 3 years of stuff they built really isn't necessary,
right.
So forth.
That's a big one.
Product is really important. And it's not just the product, the cool technology. It's where the product meets the problem. And that's where founders said, I had no idea when I said, there's a problem over there in my industry and we need software, how much thinking was required to build the right solution for the right problem. So that thinking, I'll just double down on that thinking and validation, going back and checking, is this really the problem? Is that, will you pay for this? Is that really it? Which, that's the magic trick before coders code. So,
yes. Everybody jumps to coding, right? They make that leap too quick, I think.
Yeah, I'll just reinforce that for people. If you can't have enough conversation, if you can't have conversations with 10 people, prospective customers, and say, I'm thinking about building this thing and it really solves this problem and here's some screenshots of it and you have this problem, would you pay for this product to buy to solve that problem? And can I get a pre-order right now? Like, that's the place to start. And that helps you zone in on the 20 things you could build if they're going to pay for 2 things that are on their list.
That's right. That's
just
right.
narrows it down. And
that's right.
All these people are smart people, and they just get the wheels ahead of them, myself included. So
yeah, it's easy to do, right? I think I've started to kind of use this phrase that vision is different than scope. Because a lot of times when you're building first version of the product, they've got a vision, right, for what this product is going to be, and they're trying to build to that vision versus define what your MLP scope is, go build that, right? And the rest of the vision can be built along the way, But I've seen more projects get killed because they just take on too much and they're trying to tackle too much before they actually get that validation.
Yeah, and it's a tricky thing. It's literally a psychological kind of head game for founders to go out there and sell the dream, even though, you're just starting with a little bit of it. But, pick a really hard problem that's a subset of the vision set of problems and start there. Amazon, I just saw somebody came by my window, delivered a box here. They started off with just books, just online, just in a box. Right. And maybe it was a book that arrived, so they're still doing that, but they've expanded from there. So yeah, that's a good one. You just put it on the maybe someday list and really tighten down what has to happen, must have right away, and admit that we're taking our best guess and we're probably overshooting it. It's really hard for founders to undershoot the minimum lovable product. Almost everybody gets too far ahead.
Totally. Yeah. Happens way more than not, in fact. Right.
Yeah.
So as we kind of wrap up, Greg, I know that you have Greg's List, which that's a great resource. So you guys check that out. You do, you have the podcast and you do consulting work with founders too. Can you talk a little bit about that as we're just kind of wrapping up? I think it'd be interesting to know what you do and how you help.
Yeah, I don't do deep consulting. These are early stage software founders, and they have customers and revenue. So there's some data that we can iterate on. It's not my whiteboard against their whiteboard. We're seeing what works in the real world. But I generally work with SaaS founders who have more than $1 million of revenue, and they're headed towards 5 or 10 and see what happens. Your software puzzle actually gets more complicated when you get to $1 million. It doesn't get easier. You have different segments you're trying to serve and employees and go-to-market channels, and the puzzle gets a little bit more complicated. So that's where I help as a paid strategic advisor. So it's pretty intensive, and I work with founders a few times a month. These practical founders don't have investors sitting on their boards that they could call at any time, and peer groups of all the portfolio VC-funded companies to go hang out with and commiserate with. And and it's all of the puzzle there. Sometimes it's hiring, sometimes it's product, sometimes it's selling, sometimes it's CEO head game, sometimes it's a competitor coming after you, sometimes it's operational pricing, and they all fit together. They're all connected. So you can't just do one thing without the other, including what is your end game? Where do I think this is going to go? And why do I think this will be, a worthy adventure for myself and my team?
Yeah. And, I follow you on LinkedIn, and you publish some really terrific content. I can tell you put a lot of time into that. I think your perspectives are, it's got a lot of good information. So for those of you out there that are listening, if you aren't following Greg on LinkedIn, I would encourage you to do that. Where else can people contact you if they want to be able to reach out to you, Greg?
People can message me on LinkedIn and follow my content there, but they can find me at practicalfounders.com. That's where the podcast is, and information about the SaaS CEO peer groups, and my advisory, and my few hundred 500 blog posts are there. They can see what I think about all this stuff, and I also know plenty of people who can help, just like yourself.
Excellent. All right. Well, Greg, thanks again for joining today. Enjoyed the conversation, and we'll talk to you soon.
Thanks, Jeff.